You ever walk past a small local shop and wonder, how on earth does something like that become a massive company on the stock market? I mean, it seems like an impossible jump, right? Well, today we're going to break down that exact journey, step by step.
Welcome to The Explainer. Today, we're pulling back the curtain on the stock market. We're going to do it by following the story of one company, all the way from just a simple idea to a publicly traded giant. So here's our roadmap. We'll start with how an idea even becomes a company. Then, the big one, going public with an IPO. After that, we'll explore the marketplace itself, meet all the key players, and finally, get into the rules of the game. All right, let's do this.
Okay, let's dive in. Before any company is just a ticker symbol you see on a screen, it has to start somewhere. And that's usually with just one person and a single, simple idea.
So let's imagine a founder who wants to open up a cool winter wear shop. They've saved up and they start with their own money, 5 lakh rupees. Right now, it's what you call a proprietorship. That basically means the business and the owner, they're the exact same thing. It's just them, their cash, and their dream.
But, if things go well, the business needs to grow. And to grow, the whole structure of the company has to evolve. It's a journey that almost always follows these 3 key phases. You start as a proprietorship, then you become a private limited company, and eventually a public limited company.
And guess what? The winter wear shop is a huge success. But to open more stores, the founder needs more money. Now, they could get a loan, but instead they decide to bring in some partners. And doing that means you need a new legal setup, one that treats the business as its own entity, separate from the owners. And that right there is a private limited company. Now, here's the crucial trade-off. Let's say the business is now worth double, 10 lakh rupees. To raise 1 lakh in cash, the founder sells 10% of the company to their new partners. This is called equity dilution. Yeah, they own a smaller piece of the pie now, but it's a much bigger pie, and they've got the cash they need to keep on growing. All right, now for the next big leap. The company is a huge regional success, but the founders are dreaming bigger. They want to go national. And that takes a kind of money that just a few private partners can't possibly come up with.
This is where the famous initial public offering, the IPO, comes into play. This is the moment a company goes from being private to being public. They start offering shares, which are just tiny little pieces of ownership, to literally anyone, you, me, the general public, for the very first time.
Now, this is super important to get. There are really 2 markets. The IPO happens in the primary market. That's when the company sells brand new shares and the money goes straight into the company's bank account. But that's a one-time thing. After that, all those shares get bought and sold between investors, and that happens in the secondary market. That's the stock market you see on TV every single day.
So, our little winter wear shop is now officially a public company. Its shares have been sold, and it's now part of a whole new world, a brand new ecosystem, the stock market itself. The easiest way to think of a stock exchange, like the NSE or BSE here in India, is just to picture a giant, super organized vegetable market. Seriously. But instead of connecting farmers with shoppers, it connects the buyers and sellers of company shares. Same idea, different product.
So let's just trace the flow, okay? The company creates the shares, the exchange is the marketplace where they get traded. But your shares aren't actually there. They're held safe and sound electronically in something called a depository, which is kind of like a super secure bank for your stocks. To get into this whole system, you need a broker. And the broker connects you, the client, the investor, to everything. So who are all these people, these brokers and clients that are buying and selling every day? It's time to meet the key players in this whole game. First up, the brokers. You can basically put them into 2 buckets. You've got your full-service brokers. They give you research advice, the works, but they charge more. Then you have discount brokers. They just give you the platform to buy and sell, no frills, but for a way lower cost. And then, of course, you have the investors, and they tend to fall into 4 main categories. You've got the huge overseas funds, the big domestic players like banks, really wealthy individuals, and last but not least, retail investors.
So, to put some actual names on it, FIIs, think global giants like Goldman Sachs. DIIs are the domestic powerhouses like LIC. HNIs are super successful individual investors. And retail investors? Well, that's us. That's you and me, everyday people who want to be part of the market.
Okay, with billions of rupees flying around every single day between all these different players, you have to wonder, right? who's the referee here? Who's making sure everyone plays fair?
Well, in India, that referee is SEBI, the Securities and Exchange Board of India. Think of them as the ultimate market watchdog. They write the rule book for everybody, from the big companies to the brokers, and they have one main job: to protect investors like us and make sure the whole system is transparent and fair. So there you have it. We've watched a small shop go all the way to a public company. We've met all the players, and we know the rules of the game. But, understanding the system, that's just step one. The real question, the one that really matters, is how do you figure out which company is actually worth investing in? Now that's the real game.